indirect method. Today we prepare by indirect method because SEBI wants you to prepare by the indirect method. And again there are several inconsistencies between Schedule 6 or which is now called Schedule 3 and AS3, how to prepare a cash flow statement. Preparing CFS consolidated statements you have to prepare as per 21, 23, 27 and again as per the extended definition of subsidiary. Now for associates and joint ventures, how will you prepare? Do I follow equity method or proportionate consolidation? These are words used from AS23. And Schedule 3 has a separate format for preparing consolidated statements. How do I get information from an associate for preparing my consolidated financial statements? Today, you could have got away because it was not mandated by the Act. It was only SEBI, so you could have said this information is not available, so I'll put it as an emphasis of matter paragraph in the audit report. But tomorrow, when the Act comes, it is a mandated thing that you need consolidated statements and all the information which is required because of the Schedule 3 which is there as such.
If a company doesn't have a subsidiary but have associates or joint venture, still they have to make CFS?
Yes, as the Act stands, yes. As it is given in the Act, yes, it will still have to make CFS. Because if you see this, what are financial statements? It says in case a company has subsidiary, and subsidiary here includes associate or joint venture. Because of this, that gives a lot of difficulty to a person which may not have subsidiary but only has associates and joint ventures. But see how these difficulties can come. There are three cases, and say in the first case, equity capital is 100, the holding, my holding is 100, so it is the equity capital is 100, first case it is 100, second case 30, third case 0, preference is 200, my holding is 100, 200 and 200. Now total capital is therefore 200, 230 and 200, and my what is the percentage holding in the first case? In total capital 67, in equity 100. This in the first case is a subsidiary all along, even under the old Act, under the old under the accounting standard, and you are consolidating. Now see the second and third case. In the second case, under the accounting standard you would just be an associate, but under the Companies Act you will become a subsidiary. In the third case, under the accounting standard you are neither a subsidiary nor an associate, there is no consolidation actually required. But under the Companies Act, you are now again automatically called a subsidiary and therefore you will need a consolidation. So this is how the whole thing gets extended automatically, and real estate companies have a lot of associates, joint ventures, because every new project they do under a new company, whether it is partnership or private limited or whatever. Take the case of maybe an infrastructure company. Infrastructure company again executes in different SPVs. Some of them could be just associates. Now all of them will get captured under this definition of subsidiary, which can make things very difficult as such to implement in practice. Now what however is being debated is, and the Accounting Standards Board of the Institute is debating this, and the debate is this, that when it comes to preparing financial statements, can a view be taken, especially with the rules which have come in Rule 9.4 and so on, that for the purpose of preparing financial statements, I will use the definitions given by the accounting standards, but when it comes to governance, I will use the definitions which are given by the Companies Act. Now this is a very different concept which we are trying to now, or the ASB is trying to tell the government, that for the purpose of financial statements, follow the definitions of accounting standard, which means that case 2 and 3 difficulty will go away. But when it comes to enforcing the Companies Act on governance issues, so on other disclosure issues, please follow the definition of the Companies Act. The idea of the government is really to get those companies to disclose information, to get them to disclose information for governance, who do not temper with the consolidation requirements which can remain as per the accounting standards per se. Now this is a thought which has been already accepted by ASB, and there is a meeting tomorrow which may finalize this particular thing and finally give it as a thought process to the Ministry of Company Affairs. How much they accept or it is not known, but in case they don't accept, India is in for tough times because IFRS doesn't have these definitions, the extended definitions of subsidiaries. So if you then prepare financial statements as per these definitions, the IFRS adoption also could be in difficulty, because IFRS somewhere else may mean different. In India it can mean a different thing when it comes to applying these consolidation standards which are there as such. So hopefully this distinction can or should be accepted, that for governance you do what you want. When it comes to financial statements, don't tamper with the accounting standards or definitions which are there as such. There is a schedule 3 to the Act, as we say, which is now giving you the format, which is the equivalent of the revised schedule 6. The only difference is it also contains format and guidance for consolidated statements now. There is a new concept of reopening of financial statements which is brought in. Earlier financial statements just could not be reopened unless there was just a old CLB circular that if it is required for tax loss, you can reopen your accounts, and which was used by several companies for preparing that investment allowance reserve or something, creating that investment allowance reserve. However, now you can reopen accounts under two situations: if there is a court order which is given to reopen the accounts, or you can even do a voluntary revision of accounts up to 3 preceding years on an application made to the tribunal. So the company can even go for voluntary reopening the accounts by obtaining the order of the company law tribunal, national company law tribunal, the new tribunal which will be formed. Now this, for a businessman, may seem very simple, that okay, if I have made a mistake, I will go to the tribunal and say that I have made a mistake, let me reopen my accounts. But it would entail huge responsibilities on the auditor concerned. Take a simple case like there is a search in the case of a company, and the directors in the search say that okay, I disclose on stock worth say 5 crores. And then they go to the National Company Law Tribunal that I have made this disclosure of stock to the income tax authorities. Let me go back, for this stock was accumulated over 2-3 years, let me go back 3 years and I will show this stock every year 1 crore, 2 crores and so on. Now the NCLT will obviously say, okay fine, you go back and reopen your accounts. Now what would be the auditor's role in this? Because obviously it means that in the earlier 2 years he has not been able to verify and give a proper report as such. So though reopening may look very easy, that fine, let us reopen accounts and all, what would be the auditor's role is going to be a tough thing to answer. And obviously the institute will have to be very quick in coming out with guidance on how will you face this as an auditor as such. Today if there is a mistake, there is accounting standard 5 which takes care of these mistakes when you call it a prior period item. So today what will happen is, a company which has had a search, there is two companies have had a search, both have made a disclosure of 5 crores. One company may say that I am going back to reopen my accounts. The other company may say I am not reopening my accounts, but I will show it as a prior period item, and both will be correct. Because this is an option available. This is not compulsory that you go back and reopen your accounts as such. So in spite of AS5 having been there, when the government says you go back and reopen your accounts, that is something which is not palatable really. Internationally you have got IAS 8, which says that if there is a prior period which is beyond the particular threshold, automatically you go back and restate your financial statements and reopen all the open financial statements which are there. So this is going to be a matter of debate for next several years. When you reopen your accounts, what would be the role of auditors, what will be viewed by the tax authorities and so on. But again, something which I believe the institute will have to give a lot of guidance in the interest of its members rather than in the interest of the industry as such. Your financial statements to be signed by CFO, chairman, directors, I think more the better, because everyone can have company if they need to be imprisoned. Corporate social responsibility. This is something which came in before the election code, and for obvious reasons, so that people can start planning their CSR policies from April itself. You have section 135, schedule 7 and CSR rules which combine deal with CSR. Now schedule 7 has been amended and it lays down specified activities in India to be undertaken by a company for CSR. Obviously all activities have to be in India, not outside India. It has to exclude those incurred in normal course of business. So if you are in a remote place and you have a hospital for your employees, that is not considered CSR, because that in normal course you would be doing it for your employees which is there. Group CSR or joint CSR projects are also permitted. CSR policies and activities, display them on the website. Political contributions excluded, which is rightly so, but whether it is direct, indirectly, if it amounts to a political contribution, that is very difficult to find out, but at least direct political contributions are excluded from CSR. Expenditure for capacity building costs of personnel or those implementing agencies qualify, but they are capped at 5% of the total CSR expenditure. So if I employ say 100 people in my company and I say that okay, out of this 10 people are going to do CSR activities and they will administer my CSR policies and all, the total expenditure on that administration of CSR policies is capped at 5%. So it cannot exceed that 5% as such, which can be difficult at least in the initial stages as such. To whom does the CSR apply? The CSR as well as the formation of the committee for any company having net worth 500 crores or more, turnover 1000 crores or more, net profit 5 crores or more. We believe that in this 5 crores one zero is missed out because it should have been actually 50 crores because the other two figures are quite high, but that doesn't seem to be a mistake acknowledged so far by the ministry. But what would happen is even a small derivative trader in 1 year makes a profit of 5 crores, he will get covered under CSR. And he cannot get out of it for 3 more years because to get out of it, he has to be out of CSR, this threshold for 3 more years. So if you say sell your land and building and you make this profit of 5 crores by way of capital gains, your net profit has crossed 5 crores and you will have to comply with CSR. So this is the difficulty which is there, and that is why we say that this 1 zero seems to have been missed out when they came out with these norms which are there. And you need a committee with 3 or more directors with at least 1 independent director. If it's a private company, you don't need an independent director, you can have just 2 directors who are there. The committee needs to formulate and recommend a CSR policy, ensure that 2% of average net profits of past 3 years is spent, explain reasons if you are not able to spend the money, and to monitor the CSR policy. In fact, this is a big opportunity for professionals like lot of us to help companies to develop a CSR policy and monitor it, because this will require a monitoring year after year. So I'm sure in most of the internal audit scopes in future, this area would be added to monitor and to test the CSR policy which is there. In fact, it would be a good opportunity for a lot of us because we understand the law and we can then guide a company how to monitor this CSR activities. CSR also applies to foreign companies, Indian branches and project offices of foreign companies. Now we said that if the threshold is net profit, how do I calculate that net profit threshold? It is as per financial statements, whether as per the new act or the old act, but it excludes profits generated outside India through branches or subsidiaries and dividend received from other companies also undertaking CSR activities, and net profit would be here net profit after tax. Now this is to decide my threshold of 5 crores. If however I fall within the threshold, to find out how much I spend, I don't remove anything. So for deciding my threshold, I remove all these things, but when I calculate 2% of my average net profits, I just take net profit as per section 198, which is even before tax. So because that is as per section 198, which is for managerial remuneration, so that is before tax, and dividend and profits outside India are not to be deducted for it. So for the threshold, I do a proper calculation, but when I actually come to find out how much I spend, it is actually amounting to double spending. Because if I have a subsidiary, for deciding my threshold, I will first remove it, but if I fall in the threshold, I will spend 2% of that amount. My subsidiary anyway will spend out of that amount. So there could be double spending on this particular thing, but this is a serious lacuna in the...
But that 2% is before tax.
Because it is as per section 198, which is for managerial remuneration. So for calculating the threshold, it is after tax, but to find out how much I spend, it is before tax. You understand the difference between the two things?
Calculation purpose.
Pardon?
For calculation purpose, it is after tax.
For deciding the threshold, it is before tax, after tax, but to calculate how much I spend, it is as how I calculate managerial remuneration, which is obviously before tax. So it's a big serious lacuna in that sense, because there could be multiple spending which could occur. And obviously this is a rolling thing I have to see. If I have to see 14-15, I will go backwards and see the average of last 3 years. Even if I made a loss in one particular year, the average may still come to be a positive figure, and then I will spend. The surplus from CSR activities to be plowed back, not to be included in profits, which means I cannot say that I have made a profit, that much less I will spend next year. That is not allowed. That will again be plowed back and I need to spend again in the next year. To exit CSR spending, there would be 3 consecutive years of non-applicability required. So that poor derivative trader, you will have to tell him for next 3 years, please make sure you don't make a profit of 5 crores or more. Otherwise, you will keep on spending something on CSR also year after year. There is no clarity on accounting treatment for unspent amounts on CSR. There is, however, a ESC opinion of 2013 which said that you may not need to make a provision if there is no present obligation. But that was on a PSU, not really working on the new section of CSR, but there is no clarity as of now on whether you need to make a provision for unspent CSR amounts. And obviously there is no clarity on the tax treatment. The draft rule said that the tax treatment will be notified by CBDT. The final rules have removed that particular condition. So as of now, no clarity on both these things. We'll have to wait and see what really happens. Though a lot of people say that CSR is by law, so whatever I spend will be tax deductible. I don't think it is as simple as that, because you will spend even on capital expenditure in CSR activities. It may not be as simple as made out to be, and we'll have to wait for some clear rules on this. And as usually happens, CBDT will come out with a circular saying that this will be allowed as a deduction provided these 10 conditions are met. So we'll have some such circular which will come out in the future.
Within the ends of the account, these provisions to be made at the end of the year.
That's what I said. No? There is no clarity on the unspent amount whether do I need to make a provision. It doesn't come out very clearly from the section. Only there is a ESC opinion which had said that it doesn't amount to a present obligation. If the obligation is a future obligation, I may not need to make a provision.
Sir, for deciding this criteria, it has to be at any time during the year, or it has to see at the year end whether you are completing
You will have, say for 14-15, that's the first year you decide. So you will see your 3 previous years, no? Year ending 14, 13 and 12.
fulfilling the criteria also, you have to go back to the previous year.
Yes. Yeah, so in the last year, if you have fulfilled that one of the 3 criteria, CSR applies. And then how much you spend is the average of the last 3 years. Will it be covered under AS 29? AS 29, you will have to make a provision if you can say that there is a present obligation. But that is not coming out from the section. So today the consensus seems to be that you don't need to make a provision.
You did not create a fund in that case.
Pardon?
You did not create a separate fund for
That is an appropriation, that is voluntary.
appropriation is not required, or it is required?
It's not required, because the section only says this, 135 only says whatever is unspent, you only disclose it in the director's report and why you could not spend it. It doesn't say that you provide and deposit with the government or something. So the words per se does not amount to a present obligation, so a provision does not seem to be necessary. But we'll have to wait and see how the situation evolves. Because if you don't make a provision and spend it in the next year, there could be some issues in taxation. Because they will say that, okay, this was your last year's obligation, why you are spending it this year, I will not allow you a reduction. So that's what I have already said, there is no clarity on this. Okay, let's go to the next topic on depreciation. The current provisions are as per life of an asset or the rates prescribed by Schedule 14. Schedule 14 gives you a 2-rate SLM and WDV to write off 95% of the cost of an asset. There are separate rates for double and triple shift, and assets less than 5,000 you have 100% depreciation. As per Companies Act, again this is more IFRS driven. As per Companies Act, for 2013 now you have a Schedule 2 which lays down useful life to compute depreciation. Why is this IFRS driven? IAS 16 says that depreciation has to be provided based on the life of the asset. Now, the life of the asset internationally is left to the company to decide. So obviously the first choice was you should not have something like Schedule 14, let the company decide what is the useful life of each and every asset and then depreciate accordingly. But our regulators, as they said, no, we cannot leave it to the company, they will misuse the provision. So say, let us decide what is the life of the asset of a company. So therefore the Schedule 2 which is there, and they have given a recommended life of classes of assets industry wise under 3 different categories, and we'll see what those categories are. And useful life is therefore given by this Schedule 2, and they have said the residual life cannot be more than 5%, which is what we always say, that 95% of my cost has to be written off over the useful life. However, they have complicated things by saying that we will divide companies into 3 classes. The first class of a company is those companies which comply with all the prescribed accounting standards. They can even adopt a different useful life or a residual life if an appropriate justification is given for the same. This is 100% IFRS. So if you are complying with accounting standards, I may not even follow Schedule 2. I can decide my own useful life, I can decide my own residual value also. There is a class 2 of companies which are regulated by some other law, say electricity companies, where the rates and residual lives are prescribed by that other body. So this Schedule 2 will not apply to them. And the third class is all other companies not falling in 1 or 2, where you cannot change the rates or the useful life which is given by Schedule 2. Now these are obviously those companies who are not following an accounting standard or some accounting standard and are also not regulated by some other law. They will compulsorily have to follow this useful life and residual value as per Schedule 2 which is there. And obviously class 3 you cannot have a useful life longer than or residual life value higher than that prescribed in Schedule 2. Now the problems which can come here is, in the first year I have a company which is falling under class 1. So I determine my useful life which is different than Schedule 2 and everything. In the second year I decide not to follow AS 15. I decide not to follow something on employee retirement benefits. Now in the second year then I will fall in class 3. Now having already determined the life of an asset, in the second year how do I change the life of an asset? It could be a very difficult thing. In the third year again I go back and follow schedule this AS 15.